Hi there. Today we're going to talk about high net worth financial planning, what it is, and how it's different than regular financial planning. Now, this is an exhaustive topic. We're only going to scratch the surface. We're going to do that by focusing on a couple of key aspects of high net worth financial planning. But let's first talk about, well, who needs it? So individuals, families that have $1 million in liquid assets, business owners, executives with equity compensation, those people that have complex holdings like closely held stock, or people with multiple real estate holdings, and families facing estate tax issues. The approach goes beyond simple financial planning because it tackles issues related to the situations just mentioned, related to the complexity, related to the equity compensation, the estate taxes, etc. Now, because of that complexity, there are a lot of mistakes, and there are a couple of common mistakes that you want to avoid. First of all, relying on uncoordinated advice. Secondly, treating all investments as equal. Third, ignoring advanced estate planning. Another one would be failing to involve heirs in the inevitable multi-generational decisions in management. Again, this differs from traditional financial planning. High net worth financial planning becomes critical when preliminary goals have been achieved. So it's not that this supplants traditional, normal financial planning as much as it follows on. Getting to the point where you're a high net worth individual requires some financial planning, usually. It's not just accidental. But once you get there, there's a transition because of this complexity, because of the interrelationship of all of these topics. The focus starts to shift, not just from growing the assets to get to a high net worth situation, but now on protecting the assets from various risks associated with the concentrations, with market volatility, with what now becomes punitive taxation and generational mismanagement, or at least the possibility for that. Advice is needed. Complex advice is needed for the complexity. Not surprisingly, studies show that 2/3 of wealthy individuals rely on multiple advisors at this stage of life. They have investment managers, accountants, state attorneys, bankers, insurance brokers, etc., etc., etc. Unfortunately, what's too often missing is effective coordination of all these disciplines. It's common for each specialist to make an isolated recommendation. That's essentially, if you're not coordinating, what you would be going to your CPA and asking them to do. Make an advice in your realm, in your specialty. Go to an estate planning attorney, make a recommendation in your area of specialty, etc. It can be entirely accurate and beneficial when considered as a standalone recommendation, but nonetheless, it ends up negatively impacting another area outside that particular professional's expertise. For example, a CPA's advice to minimize taxes in any one single year might contradict advice you receive elsewhere that says, let's minimize taxes over a lifetime, which means we're not going to focus on just any one year. It's not that the CPA's advice was wrong, it's just it didn't fit in a more complex, longer situation. So what's missing is a sense of a financial quarterback, someone that has the job of designing the total plan, coordinating each of the other needed professionals' work to accomplish all the goals. Now, let's quickly, I'm not going to delve into the details of this, but let's quickly look at the tax code conceptually. You have income taxes, and you got the teens, 20s, and 30s, and I don't mean your age. These are the brackets, the general brackets. So you've got the general brackets right now of 10% and 12%. Then you jump to the 22 and 24% brackets. Then you've got the 32, the 35, and the 37% brackets. Now those are obviously specific to this year as I'm filming, but they've been pretty much the broad categories for a very long time. You've got some very low ones, some middle ones, and then you get into some high ones. And the high ones, if you add in states like California, you're going to move from your 30s into the 50% range very, very quickly. You've also got capital gains taxes. Now those are 15% and 20%, a little bit lower than income tax ranges. But again, you add in California and states like that, which treat capital gains as regular incomes. Now you're adding in more, and you're taking the top bracket for capital gains to 32%. And finally, there's estate taxes, which are at 40% if you're over the lifetime exemption. You, if you're a high net worth individual, are in what the military calls a target-rich environment. What it means essentially is if you're targeting one target, one individual, one tank, one ship, whatever, you got so many in the area that if you miss the first one, you're going to hit others. And unfortunately, as a high net worth individual, you are a target and you're in the middle of a group of targets. States, the feds are coming for the extra taxes. You may also be a super target. And I say that because many high net worth individuals believe right now that their heirs are not going to incur estate taxes. They look at the $30 million lifetime exemption to estate tax, go, I'm not there, and that ends the conversation. They don't see that, no, you may be there, very reasonably you may be there in a very short amount of time. That makes you a super target because the taxing authorities are looking at the income taxes, the capital gains taxes they get from you, and now the estate taxes. See, the relevant number is not your net worth today. It's what your net worth is likely to be in 20 years or so, and I'm basing that on just your average person retiring at 60 to 64, and the mortality tables in the United States say you're going to live anywhere from 20 to 25 years. So it's not what you're retiring with, it's not what your net worth is right now, it's what it's going to be between now and when you pass your wealth on to your heirs. This problem becomes even more severe the longer that you live. For example, $6.6 million in net worth today is going to generate state taxes in 15 years at a 6% growth rate. That is not, by the way, an unreasonable growth rate. That's what I'm going to use the word moderate, I don't necessarily like that word, but what a moderate portfolio, a balanced portfolio would do in that amount of time. $5 million today would subject you to significant estate taxes in 15 years. $8 million today is going to have estate taxes for you in 10 years at 6%. So different rates of time and different net worths still mean you're going to have an estate tax. And none of those numbers that I use, 6 million, 5 million, 8 million, none of those are anywhere close to the lifetime exemption. But it's going to grow, and that compounding effect puts you into that estate tax range even if you don't realize it. Now the good news is there are solutions to these high net worth problems. First thing we're going to do is look at a couple of examples. How did real clients deal with the problem? First, identify the problem, and then how do they solve it? So let's take a look at advancing and protecting investments. This is one of the most common mistakes that I mentioned. I'm going to consider the case of Amanda and Austin. Yes, change the names, but these are real clients. Amanda and Austin are in their early 60s. They were eagerly looking forward to retirement in the next 2 to 3 years. They have amassed a significant amount of assets and family, at about $6 million in 2 investment accounts, a living trust account, and 1 401k. They've got 3 kids, each with 3 grandkids, for a total of 9 grandchildren. Their living expenses are relatively straightforward, and based on retirement projections, they're only really going to need about $2 million to sustain their projected lifestyle, given a nice pension that Austin's employer is offering. Now that leaves roughly $4 million in investment assets that really aren't needed to sustain retirement. Now, like many clients in their situation, they looked at their total investment nest egg as one big portfolio. They allowed a previous advisor to structure it along the traditional brokerage model to achieve moderate growth. Now, since these brokerage models use these general terms, moderate growth, moderate, conservative, aggressive growth, income, whatever, they're broad. They mean different things to different people. Amanda and Austin did not really have any idea what type of return they should expect from the portfolio, nor what downside looked like in a really, really bad market. Most significantly, all the accounts are being treated the same, even though the client clearly had different life goals. The basic goal, they obviously want to retire and enjoy their living standard they've worked hard for. Okay? It's clear enough. But on top of that, they wanted to be able to bless their kids and their grandkids in the future. They wanted to be able to help them with college costs, down payments on homes, etc. The problem here is they were not confident they would have enough money for their entire retirement. They didn't feel that they could gift early or even make plans for kids and grandkids because they were a little unsure of their own future. And they're going to pay more taxes in their lifetime than they needed to. The solution in their case, we utilize what's called an investment policy statement. An investment policy statement gets very, very specific in identifying what's the target return. Well, first of all, what's the portfolio? Doesn't need to be the whole big portfolio. You can have different portfolios, one for this age, and this age. But then for each portfolio, what's the target return? Not a guarantee, but what's the target return? What's the volatility and downside risk associated with that? Does that register with both your heart and your head, your intellect and your emotions? Are you going to be okay with this? What does the downside look like? What does liquidity in those downsides look like? That's what the investment policy statement spells out. Okay? With that information laid out in this format, they were quickly able to realize that their concern about volatility and liquidity, which is normal, but was more confined to the investments that would sustain the retirement lifestyle than it was applicable to the accounts which could be targeted for their kids and their grandkids. They quickly decided, therefore, that they could have 3 different portfolio structures, 3 different portfolios, if you will, one for them, one for each of the kids, with, say, 10-year goals, one for the grandkids with, say, 20 to 25-year down the line goals. We actually recommended, with this structure, decreasing the target return and therefore the volatility for the account which was going to sustain Austin and Amanda. This also better protected liquidity during their retirement. Now, we increased the target returns for the other accounts, so they weren't just the same. There was an increased rate of return for the one focused on their kids and an even greater target rate of return for the ones for their grandkids. Now, this did, yes, it added volatility for those other 2 accounts, those other 2 portfolios, but this didn't bother Austin and Amanda because they saw that they wouldn't likely need those funds. Those funds could be long-term. They could go up and they could go down for years and decades before they would be needed, before that volatility would really bother the outcome. This also allowed them to reduce lifetime taxes because longer-term portfolios usually see more capital gains than income. And we also did some converting into tax-free Roths. The net result here was a projected potential increase in investment assets, roughly $5 million over 20 years, $9 million over 25 years. Now these, again, they were not guaranteed. They were projections meant to be accurate, not to the dollar, but generally in line with, well, what are your goals? Will it sustain you? Will it meet the goal with a sufficient margin of error that you know you're going to get there? We presented the rationale for each of them, why they were achievable, showed them mathematically, with history, what the compounding effect's going to do over multiple decades, what their liquidity needs would be. The client came to understand and internalize those different targets, which is exactly what that investment policy allowed them to do. The results, they were, one, much more confident that they were going to be able to do what they wanted to do. They could maintain their lifestyle. They minimized liquidity risk during retirement. They were able to gift with confidence now, and they were able to position assets for better potential growth for their family and reduce taxes over the whole lifetime. Now, it's a great outcome. That's focused on just one element. I did promise to keep this short. It is an exhaustive topic after all, so let's just take a look at one more case study. We'll go to the opposite end of the spectrum, shielding growth from estate taxes. This is the case of Roger and Cynthia. They're clients with $5 million spread over 3 investment accounts, typical trust account, 1 IRA for each of them. But they also have $7 million in real estate spread between a primary residence, vacation home, and the building which houses their business, and they've got a $15 million business conservatively valued. Their total net worth is just under the current lifetime estate tax exemption of $30 million. They have a standard set of estate documents, the wills, powers of attorney, a living trust. These are going to allow for a very smooth probate fee transition after the death to their 3 sons. The 3 sons work in the family business. They would like to ultimately keep it after mom and dad pass away. Now, like many entrepreneurs, these business owners, they were focusing more on they didn't worry about estate taxes because they were focusing on the investment accounts and on the investment real estate in terms of supporting them in retirement. The business, in a certain sense, was an afterthought as part of the net worth and as part of the potential tax problem. They didn't see the value of the business for what it represented. Yeah, it's a great net worth, it's a positive, but it's also a big risk factor. The problem was this puts them very close to the current exemption. Projecting them to live another 20 years with moderate growth, their future net worth was really at risk, and we saw them hitting about $12 million in estate taxes, even after adjusting for inflation exemption increases. This was going to force the sale of some of the real estate and or the business. This is not the outcome that they wanted. Fortunately, as I said, there was a solution. We designed a family limited partnership structure for the real estate and the business. We used dynasty trusts also to protect from lawsuits and mismanagement. Now, it's a complex topic, but I'll quickly cut to where the benefit is on family limited partnerships and dynasty trusts. Because of discounts that you can receive, discounts that the IRS acknowledges, you're going to reduce the taxable estate today. So that $27 million gets reduced down for tax purposes to something closer to $12 million, $15 million. But it's also going to keep future growth on those key assets outside of the state tax calculation. They may grow back up to 27 or 30 or 40 or $50 million over time, but that growth is not going to get taxed. Accordingly, we projected that for the next 20 years, there would be no estate tax for this family. Retirement liquidity was safe. We showed that Roger and Cynthia could rely on their investment accounts to fund their lifestyle in retirement, so they could free up the other assets for some of these advanced planning techniques. Now, that last point is significant. Some composition of net worths won't work in family limited partnership. That doesn't mean there aren't other tools. We just focused on this one in this example. The point is that there are, if you will, two different types of problems that we've highlighted today at both kind of extremes. And there are solutions for both. But you need to be getting the right advice. You need to be working on them and realize that you've got this problem. I'm often asked, well, when I speak on the topic or when we write, we get feedback. So where do we start? And I always say the same thing. You need to get objective advice. It's complex, it's complicated. You can't try to do this alone. And you can't do this from someone who has a conflict of interest, who's going to try to sell a product. This, in a certain sense, is the other way, which I feel makes you a super target. This financial services industry, of which we're a part, unfortunately, is full of wolves in sheep's clothing, more specifically, product pitchers posing as advisors, and I'll use air quotes there because I don't think a real advisor ought to be pushing product. The only place to truly get objective advice is with a fiduciary advisor, someone that's obligated to follow the fiduciary standard, the gold standard. It means the advisor is legally bound to act in your best interest, and we would add always, at all times. If you're not working with someone who's using the fiduciary standard, they are using what's called the suitability standard. And that means that this advisor only needs to recommend investments or make general recommendations that are appropriate as deemed by very general legal guidelines. That means they can suggest higher cost options that are appropriate, not cheaper alternative ones that are better, that work in your situation specifically. It's product sales, high commissions, it's advice that's slanted toward the broker's interest. Now, I mentioned always a few minutes ago, because unfortunately right now this term fiduciary has been warped. You are now allowed to act as a fiduciary in some instances, and then switch the hat and become a non-fiduciary. I don't think that's right, but that's what it is. So you're looking for someone to work with for objective advice at all times. So you need a fiduciary advisor who will always be a fiduciary advisor. This difference for high net worth individuals has serious consequences. So you want to consider an advisor by asking them directly, are you a fiduciary 100% of the time? Ask for that in writing. So ultimately, is high net worth financial planning right for you? Well, when your financial situation becomes more intricate, a dedicated wealth advisor is no longer a luxury, it's a necessity. If you're juggling multiple business enterprises, managing concentrated stock positions, if you don't have a clear idea of what your taxes are going to be across your entire lifetime, if you're receiving fragmented advice from various professionals, it's likely time to reevaluate the approach. You need someone who's 100% objective, 100% of the time, and who can take on that quarterbacking role. Remember, a CPA can act as a fiduciary. Your lawyer can act as a fiduciary, but again, if they're remaining in their silos, their areas of deep specialty, they're not quarterbacking, not putting together a whole plan. They're not making sure that all the advice you're getting is focused on the same goals and getting you to where you need to be. That's what the holistic advisor will do. They will determine the right strategy. They'll develop that for you. They'll coordinate the other professionals who are needed for the specialty work. Not diminishing their specialties, their silos. We're just making sure that it gets done in a coordinated fashion. And that fiduciary, that holistic advisor, is going to monitor progress toward all your goals each year. It's not just one and done. So in conclusion, if you are a candidate for high net worth financial planning, don't try to do this alone. Don't work with someone who's inexperienced or conflicted, who you or I would put air quotes around the term advisor, but it's really pushing product. The downside risks overwhelm whatever pie-in-the-sky promises that the product pushes are going to make. This is the time for professional, experienced, comprehensive, objective help. We would love to chat. We would love to learn more about your situation and see how our fiduciary, holistic, comprehensive approach is going to help you. Give us a shout. Again, thanks for listening.